What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Friday, everybody. While China has been on holiday all this week, preparing for the year of the tiger with friends and family, the United States has been busy preparing for the next stages in the highly competitive great power contest between it and the Middle Kingdom. We have seen both words and the beginnings of actions from the United States this week. At a special event on Monday evening at the Reagan Presidential Library, the current United States FBI director spoke to an audience about the risks he believes the US is facing domestically from the People's Republic of China. During the event, the top domestic security chief went into details about what the FBI is doing domestically to counter China, explaining that the FBI is opening new cases to counter Chinese intelligence operations approximately every 12 hours. Quote, "When we tally up what we see in our investigations, over 2,000 of which are focused on the Chinese government trying to steal our information or technology, there's just no country that presents a broader threat to our ideas, innovation, and economic security than China." End quote. This week, the United States House of Representatives has been debating the so-called America Competes Act, which supporters argue is designed to better compete with China. We remember that the US Senate already passed the US Innovation and Competition Act last year, which allocates hundreds of billions of dollars for the semiconductor industry in the US and technology development generally. If the House passes the America Competes Act, the two chambers will need to resolve the two versions. The Biden administration has been actively promoting the bill, which, similar to the Senate bill, includes approximately $52 billion to subsidize semiconductor manufacturing and research. House Republicans have complained that Democrats did not include them in drafting the legislation, pointing out that one provision, which would authorize $8 billion to the Green Climate Fund established by the Paris Agreement, has little to do with competing with China in technology. But this is a China-focused channel, so let's not wade into US domestic politics here. All we need to know for our purposes is that the general spirit of the legislation, competing with China in technology and other areas, enjoys broad bipartisan support. Indeed, more than a dozen former national security officials with Democratic and Republican administrations have written to Congress this week calling for bipartisan support for the policy behind the bill. In the open letter, signed by 16 former national security officials, including former President Barack Obama's defense secretary and the national security advisor to George W. Bush, the signatories express, quote, "This is the time to prioritize comprehensive, bipartisan competitiveness legislation, which will ensure that federal investment matches our national security interests and allows the United States to maintain strengths and comparative advantages." We'll have more on US moves to compete with China in tomorrow's video. Next up, Chinese economic and financial updates. Just a reminder for those viewers who didn't watch Wednesday's China update, the International Monetary Fund this week published a special report calling on China to step up fiscal support to bolster the economy. IMF reports are typically very softly worded when it comes to China, so the language of this report should be taken seriously and suggests that officials with the fund are deeply concerned for the Chinese economy. With the report, the IMF also cut its 2022 growth forecast for China to 4.8% from the previous estimation of 5.7%. Policy recommendations included moving away from unproductive infrastructure spending and increasing household income through social support programs. The IMF is concerned with weakening consumption and the property sector crisis. Quote, "China's recovery is well advanced, but it lacks balance and momentum has slowed." End quote. Hit up Wednesday's China update for a deep dive into the IMF report and what it means for the Chinese economy going forward. Chinese financial media outlet Caixin Media reports that major Chinese vaccine makers are expected to, quote, "report a major surge in profits last year on the back of the nationwide COVID-19 inoculation program that has seen more than 3 billion doses administered, the biggest such rollout in the world," end quote. According to company filings, Tianjin-based CanSino Biologics Inc., maker of a single-dose vaccine, estimates almost $300 million in net profits from 2021. Beijing's crackdown on the Macau casino junket industry, a sector long suspected, and for good reason, of supporting capital flight from the mainland, continues into 2022. This week, police in the Macau Special Administrative Region arrested the city's number 2 junket boss, Wang Linchan, chief executive officer and controlling shareholder of Macau Legend Development Limited. We remember that the city's biggest junket boss, the head of Sun City Group, was arrested in November last year. We covered the arrest and the implications for the Macau economy and the wider casino business at the time. The noose has been tightening around the neck of Macau's VIP junket business for years now. At its peak in 2013, gambling revenue for the VIP segment of Macau casinos reached $30 billion, accounting for 66% of total gambling revenue in the city. Almost all of this revenue came from wealthy mainland clients. After years of tightening restrictions and crackdowns on cross-border gambling and corruption, data from Citigroup shows that this VIP segment dropped to just 15% of total earnings in Macau casinos just before the pandemic in late 2019. In an official statement after his arrest, Chan resigned from his position, but expressed that the arrest shouldn't impact daily operations in any material way. Markets, however, disagreed. The first trading day after the arrest, the casino's Hong Kong traded shares plunged 19%. The biggest loss since 2015. And speaking of poor economic performance, that brings us nicely to Evergrande. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. Downward spiral, collapse, plunge, in other terms, are what I am seeing from normally sober analysts in the industry discussing the January numbers. According to data from the China Real Estate Information Corp, CRIC, China's real estate market continued its plunge in January this year, with total sales of China's top 100 property developers falling an incredible 39.6% year-on-year by value. CRIC predicts that sales will continue to fall in February. In its report, the CRIC writes that most of the top 100 property companies recorded lower sales in January than last year, and the value of monthly sales was lower than the 2021 average by 43%. China Evergrande Group, one of China's largest developers and crisis hit, as we all know, saw its sales sink to 49th place with just $460 million worth of sales. A year ago, during much happier days for the developer, Evergrande's January sales were 5th in the country, with sales almost 12 times greater than what we saw last month. Analysts with Caixin Media discussing the data in the report observed yesterday that China's property market boomed in the first half of 2021 before falling into a slump as regulatory curbs on borrowing left developers struggling to pay back their debts. We've been following the sector very closely for months now, and so we would agree with this observation. Quote, sales of China's top 100 developers surged 83% year-on-year in the first quarter, before slowing down in the second quarter and ending the year with a 3.5% decline for the whole year. Some developers, including Evergrande and Hong Kong-listed Shimao Group Holdings Limited, have defaulted on bonds or come under liquidity pressure. End quote. Again, we would agree with this analysis. Analysts at brokerage Huatai Securities, in a recent research note, warned that financing pressure is unlikely to ease for developers this year. Credit ratings agencies internationally too point out that the first quarter of this year, developers need to meet obligations to repay $20 billion in maturing offshore bonds. This represents a record quarterly high. The China Real Estate Information Corp report also touched on a point which we have discussed on China Update for months now, the likely soft nationalization of real estate projects, with Caixin analysts expressing, quote, although liquidity will continue to be a problem for developers in debt trouble, some state-owned and private developers with better balance sheets can seize the opportunity to acquire projects and assets. The central government is also supporting the acquisition of real estate projects to diffuse risks and restore market confidence. However, with the collapse we've seen over the last few months, they're probably going to have to do a lot more than just that.
Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.